Okay, you should all be seeing my screen with the little code on it. Let me just make sure that it's all nice and size. Takes up the screen. One more background. Okay. Let's do that. Okay, so I've got people that can hear me, and there's quite a few that are doing FAC3701 or FAC3761, which is the full year module, and then obviously FAC3702 as well. That's great. Okay, so let me get started. It's always a little bit tricky running these things on your own because I want to keep track of the comments and the questions, but that means that I have to talk and listen and write at the same time. So if I'm a little distracted, it's because I'm trying to read comments or read questions and listen, you know, and talk and make sure that I don't say something stupid at the same time, which is, I mean, I'm a girl, so I can multitask, but still, we need to make sure that I don't do something stupid. Okay, so before we begin, welcome everyone. I'm really, really glad that you joined today. The discussion here is deferred tax. I'm going to say basics because I want to focus on the basics because you need the foundation in order to be able to build on. So we have a habit of kind of, you know, we struggle with the theory, we spend time on the theory, and then, you know, by the time, you know, when it gets a little closer to the exam, then we're like, oh crap, I'm still not entirely comfortable, and, you know, I'm still not like, you know, not perfectly comfortable with the stuff, but now I have to jump to questions, and then we have a tendency to jump to complicated questions. You know, so we'll go straight from 0 to exam level questions, which you kind of, you know, you need to do, but it's tricky to do that when you still, you know, you don't really get the basics. So, you know, we kind of have that gap, and then you're trying desperately to figure out how to do stuff. And then we end up focusing on, you know, we kind of learn rhymes and rules and if this then that and if this then that, instead of being able to think about it. So a large part of what I want to do today is kind of stick to the basics, because if you can think of the basics, you know, in an exam, instead of, you know, relying solely on if this then that, if this then that, when you get to complicated stuff or stuff that you haven't really seen before, or you have a bit of a panic or a little bit of a wobble in the exam, I need you to be able to think about it a little bit more. So we're going to focus on basics today. The first thing, again, if I can just make sure if a couple of you can just kind of, if you can just put in the thing that you can see the screen, because obviously without the screen this is going to be like super difficult. So what you should be looking at is a little screen that's got a little discount code for you. So if you are an undergrad, which most of you are, if you're an undergrad and you're looking to do exam courses, one of which obviously is the FAC3701 and, you know, whatever else we do, all the tax and the auditing and everything, well, and the manic, big problem, we know. Then when you register, use the code exam10, and that will give you a 10% discount on the exam course, on any exam course. So that's cool. And then if you have any questions, please don't email me, because I'm not part of, you know, I'm just lecturing, so I focus on the content stuff. If you have any questions about courses and please email queries@tubaldi.com. So before we carry on, we've kind of added in a little, I don't know what you want to call it, a little prize for our webinar attendees, because we kind of know that stuff is a little crap at the moment and life is a little difficult, and you're all struggling with your exams. So what I'm going to do is I'm going to ask you a question, and the first person to type out the answer in the questions, the right answer in the question, will get a free exam course. So all you need to do when I give you the question is literally just write out the answer and press enter in the little question, and I will obviously see your answer and I'll see who it is, and then I will contact you. I will contact you after the session to get your details so that so that we can give you and you can redeem your free exam course. So that's pretty cool. I like that. Okay, so I'm going to assume that you hear me and that you're ready. So my question, what side, debit or credit, really simple question, what side, debit or credit, do assets increase on? Do assets increase on the debit or the credit side? Shit, you guys are fast, man. Holy crap, you guys are fast. Alrighty. So, okay, well, one, I'm very glad to see that you all got it right. So well done, man. Shit, you guys are fast. Okay, so we have congratulations to Miva. You've got a free exam course. I will contact you after the session to give you the details, to get hold of your details. Awesome, guys. Like, I didn't realize you were so fast. I hardly got the word on my mouth. Alrighty, okay, let's focus on what we have to do. Let's focus on the good stuff. So, the first thing I want to do when we talk about deferred tax, okay, the first thing I want to do is I want to focus your attention on what an asset is. I'm not going to go into, I'm not going to go into to big fat definitions or all that crap. But what I want, what I want you to look at is when we're looking at asset balances, on the statement of financial position, when you think about an asset, when you think about stuff, when you're looking at the stuff, I want you to continually be aware that what you're looking at is the future. Okay, it's really easy to look at an asset and go, oh, we've got a 100,000 Rand asset, and that means that we bought a 100,000 Rand asset. Okay, so we have a tendency to focus on the past. But when it comes to asset, why did you recognize that asset? Because you believe that somewhere in the future, you are going to get future economic benefits, right? So that 100,000 is going to represent future economic benefits, right? You don't raise an asset. You don't raise an asset if there's no future economic benefit. So, the 100,000 that you raise is not because of the past, okay? The 100,000 that you raise is because you believe that you're going to get 100,000 Rands worth of value from this in the future. And that could either be as a result of selling crap and realizing money. So you sell stuff and get money in that way. Or, when you talk about assets and PPE, you're going to make some kind of profit off of that, right? You're making operating income off of that. So, you have an asset and it, helps you make products and you sell those products and therefore you have an operating income. So when you look at assets, it's really important to understand that it's about future economic benefits, okay? And you are recognizing future economic benefits, okay? And that's what an asset is. And the liability is the same. If you have a 100,000 Rand liability, the reason that you raise it is not because of something that happened in the past. It's a recognition of the fact that you have future outflows, that in the future, you are going to have to give out money, right? And you are raising the 100,000 as a recognition of the fact that in the future. So all I want to do when you're dealing with deferred tax, a lot of reason that people and students struggle with this is because it's a default thinking to think about assets and liabilities in the past. We think about the past and we think about depreciation or whatever. I need you to be thinking about the future. Fine, future. Okay, so I've got a little example here and I kind of drew it out in advance because, we only have half an hour and it does, we don't want to take up like forever. So what I've done here is create basically, what they're looking for in the exam. Okay, so I know that you guys, you kind of start off by doing your sort of little nursery rhyme thing, if the tax base of an asset, if the carrying value of an asset, but I kind of want to approach this and make you think about it. So I've kind of got an example here and I'm sort of saying, if we assume that a company, buys an asset on like the last day of 2009, like the very last day, then there won't be any depreciation. So you'll have a cost of 5,000 and you'll have, therefore your carrying amount is 5,000. So what does that mean to us? What does that actually mean to us in terms of our deferred tax and what, what are we going to do with that? So let's take a look at that. When we are talking about our deferred tax, okay? What we're saying is that we have accounting stuff and we have tax stuff, okay? So this is for us, this is for our accounting stuff, and this is basically for SARS, for the receiver. So it's almost like saying, you know, there are two separate rules, and you'll have profits, and you'll have expenses, and you'll have income, and you'll have all sorts of stuff. And the question is, what do you do with it for tax? I mean, for accounting, and what do you do with it for tax? Okay, so in some cases, you know, if we take, you know, like in some simple cases, the question is, you know, what do we do for it in accounting? And the answer is, yes, we do that. And the receiver says, yes, we do the same thing. And that's cool. That's nice and easy, nice and simple. And then in some cases, we have expenses and we say, well, we recognize an expense, and the receiver says, yeah, we recognize the same thing as a deduction, expense for us, deduction for the receiver. And so therefore we're all good, right? So that's nice and easy, that's fine, and we're all good with that. But then there's stuff that happens. There's certain, let's say there's certain expenses that we have that we say, yes, we recognize the expense for accounting purposes, and the receiver goes, I don't know what you're talking about. Like, never heard of it, not interested. Like, I'm not giving you a deduction for that. Like, I don't even acknowledge it. Okay, so these little dudes is where our permanent differences come in, because the receiver is permanently different. You know, the tax is permanently different. Like, he's never going to recognize that. So fines, for example, you know, like traffic fines or penalties or fines, whatever the case is. The receiver's going, I don't care. Like, I don't care what you've done. I'm not interested. Okay, so that creates a permanent difference. Then there's other expenses, and you know, the most common one is depreciation, for example, where you go, yes, we recognize depreciation, and the receiver goes, yes, but you know, yes, we do recognize, but not quite the same. So yeah, we do it slightly differently to the way that you do it, and this is where our temporary differences come in. Okay, so the temporary difference, just like the name says, is basically saying, yes, we do recognize it, but we don't recognize it the same way that you do. We recognize it over different times. And the important thing about this, and again, you know, I want you to remember this, like about the future, when this happens, you know, if we assume that these are different years, the idea behind temporary differences is that there may be a difference. You know, there'll be a difference, there'll be a difference, there'll be a difference, there'll be a difference. But when you look at them all together, they're going to be the same. So when you take it over the period of time, they're going to be the same. So maybe for accounting purposes, for example, you'd recognize, you know, the expenses as 100 in the first year, and, you know, you don't have anything in 4 years. And the tax says, sure, we recognize 100, but we're going to do it, you know, we're going to split it over the years. Okay, so you can see that in year 1, there's a difference. In year 2, there's a difference. In year 3, there's a difference. And in year 4, there's a difference. But when you take it all together, the total that you recognized for accounting was 100, and the total that you recognized for tax was 100. Okay, so that's why it's a temporary difference, because when you look at that item, that transaction, that asset, that liability, or whatever as a whole, once it's all flushed out, it's all going to come back to the same thing. That's why it is temporary. So it flushes out, it reverses out. Okay, so this is why you're going to hear about, like, you know, the tax, you know, it reverses out. So you may not get it now, but you will get it in the future, the future, the future, the future. Okay, continually. If while I'm busy talking, if you can just dump a little answer in there, or a little like comment in the questions whether or not that makes sense to you and whether or not you're comfortable with that, so that I just know, like, you know, what planet you're on while we're here. Okay, so the future, I need you to be looking at the future. I need you to be kind of asking yourself, what does this mean for me in the future? What does this mean for me in the future? When you think of an asset, I don't want you thinking of, what's the past? I want you thinking, what does this mean for me in the future? What does this mean for me in the future? It means that in the future, you know, I'm going to get economic benefits from the future. Okay, and when you think about it that way, you start realizing, oh, this is why, you know, all the pluses and the minuses and all that crap. So we'll get to that. Okay, so now keeping that in mind, our carrying amount is basically saying, like, what does our accounting say we can do with this? And we know that, right? That's your cost less your accumulated depreciation. We know that we get to depreciate that on we get to depreciate that on an annual basis, and that's cool. Okay, we know that. The tax base says, okay, the tax base is basically saying, like, what is the receiver's carrying amount? What do they see as their carrying amount? Okay, and that's kind of different. They calculate theirs a little bit differently to ours. So when we look at that, we're saying, let's compare what our rules and our world says and what their rules and what their world says to us. So that's fine. So in the beginning, like on the day that we buy that asset, we recognize that 5,000 Rand, we bought the asset, that's going to be our future economic benefit. What does that mean for for the tax? How does the tax see it? And in terms of your tax base of an asset is your future tax deductions. Okay, and I'm going to send you the scribbles that I'm making. So don't worry if don't worry about trying to follow the scribbles, because then you're going to lose track of the conversation. So I will send you the scribbles. Okay, so fine. So your tax base, basically, you're recognizing your future tax deductions. And again, I want you to pay attention to the fact that we're focusing on is like, what does this mean for me in the future? The value of your asset is saying, in the future, I'm going to get tax deductions. I'm going to get tax deductions. And because nothing has happened yet, your carrying amount less your tax base, there's no difference. There's no difference, because at the moment, the receiver has said, I'm going to give you 5,000 Rand worth of future tax deductions, and the accountant has said, this is worth 5,000 Rand future economic benefit, and therefore we're all good. Okay, we're all fine, not a problem, no difference, fine. Now let's go to the next year. We'll start actually looking at, the difference. Oh my goodness, I'm moving the wrong thing. Please don't, there we go. Every now and then technology kind of lets you down when you least need it. Okay, so now let's say we look at the next year. Your PPE the next year, your cost is obviously still 5,000. Let's assume that you have depreciated it by 2,500 Rand for accounting purposes. Okay, so you've depreciated it, you've had the depreciation is 2,500 Rand. Okay, so your accumulated depreciation 2,500, and you now have a carrying amount of 2,500, which indicates 2,500 Rands worth of future economic benefit. Let's assume for these purposes that the taxman says to you, you can take the full deduction in the first year. Okay, so your future, your deduction for the year, your wear and tear is 5,000. Okay, so that's great. Now we're sitting in a position where we go, the future tax deductions is now 0. Okay, so you don't get anything in the future. So your balance at the end of the year, you don't get anything in the future, which means you're sitting with a temporary difference of 2,500. Now, most of us go straight to this and we go, okay, times 28%, what does that mean for here? And then we kind of go, and the big issue for a lot of students is this an asset or liability? And the problem with this is that you're going to get marks or you're not going to get marks depending on whether or not you have the sign right here. Now, most of us focus on this, on the deferred tax. I want you to focus a little bit more on the temporary difference, because this is, sorry, wrong pen. This is, this is where the thinking comes in, okay? If I have a 2,500 future economic benefit coming in, okay, because that's future economic benefit. So I've got 2,500 future economic benefit coming in, and I've got no tax deductions in the future, okay? What does that mean for this number? What does that mean for that number, right? That means that that number is taxable, okay? That means that that number is taxable. Why? Well, because when you get your future economic benefits, you're going to have to pay tax on it. So your future economic benefit, for example, let's say sales, like it's sales. okay, you're going to have to pay tax on that. You don't get any deductions on that. So this is taxable. Okay, so that is taxable. And that means if it's taxable in the future, okay, it's taxable in the future, which means that that's going to create a liability for you. So you can see if you start focusing a little bit more on whether or not your temporary difference here is taxable or deductible, and you actually think about it a little bit, then you can get a little closer to whether or not that is an asset or a liability. So this is also why I said to you, I want you to think about what the impact of that is. Like, what is the impact of your asset? The impact of the asset is future economic benefits, right? And if you're getting future economic benefit, if you get like 100 future economic benefit, what are you going to have to do? You're going to have to pay tax, right? That's what you're going to have to do. So this then is going to become a taxable difference. Okay, taxable, taxable, taxable. So one of the things that we've got to focus on, oh, sorry, my little Zoom function is a little unhappy at the moment. Okay, so one of the things that they ask you then to do is to say, okay, that's fantastic. Now talk to me about what's happening with your current tax. Okay, so let's now look at the current tax for 2011. Let's move him. Sorry, for 2010, let's move him completely out the way. You try and make things easier with technology and then it actually makes it worse. Sorry. Okay, so let's say your profit before tax was 100,000, fine. When we do this, there are two ways that we can go about this. Either we just put the movement in temporary different balance in there, or we actually calculate what that is. Okay, so our current tax balance says you have to recognize what's going on with the movements in temporary differences. You have to tell me what's going on. So you have to take all the crap that's going on over there, all the temporary difference and the deferred tax, and you've got to tell me what's happening, and it has an impact on your current tax. It's got an impact on your current tax calculation. Okay, so oh my goodness, I've put this in the wrong order. Let me just delete these boxes. I'm so sorry. I thought it would make life a little bit easier if I put these boxes here, and now I haven't. I've actually made life a lot more complicated for everybody. And it's not working. I'm so sorry. It's amazing when you want stuff to work, it just decides it's absolutely not going to. Okay. Let me do this underneath here. There's no point in pleading for it to work. I'm very sorry, guys. Well, it's not like it's not complicated enough. We've got to make your life more difficult as it is, right? Okay, so let's say we're looking at the year. Sorry, I got my years mixed up because I'm very smart like that. Apologize profusely. Okay, so what they say is whatever's happening with your tax, you need to recognize that in your profit and loss calculation, because you've got to calculate what on earth is going to the receiver, and all of the stuff is going to flush out there. So what they're saying basically is like, talk to me about the difference between the accounting and the tax. Okay, so what you would do with your profit before tax is say, okay, so we got to our profit before tax by doing all the accounting stuff, right? So the 100,000 was there because we took sales and cost of sales and expenses and and everything is in there. Everything is in the 100,000. Okay, and I think that's important to understand. Like the profit before tax is like everything's been done, all your accounting rules are followed. Now, what follows is to say, okay, talk to me about the tax. Talk to me about the tax. You've done all the accounting stuff. Now we need to kind of reconcile to what the receiver would say, like, what does the tax do? Now we go, okay, all right, fine, let's go back. So one of the first things we do, if there is any kind of difference, if the receiver says, we don't like your stuff, then we have to recognize that. And that's where your permanent differences come in, right? So if the receiver says, Well, part of your, when you calculated your profit before tax, you had like a 2,000 Rand, fine. I don't give it, like, I'm not taking, I'm not allowing you to do that. Then you have to take that fine and go, okay, well, we had a traffic fine and actually that's not okay. The receiver doesn't recognize it. We're going to have to add that back. So as far as the receiver is concerned, your taxable income is actually 102,000 because they're going, I don't care. You took 2,000 off there, for your fine for accounting purposes, and I don't like that. I'm not interested. Like, I don't care. Add that back. I'm not giving that to you. Okay. So it's important to understand that, all of this is based on the rules, and we're kind of going, okay, what does the accounting say, and what does the receiver say? Now, when we come to, that's how permanent differences are nice and easy, right? Like, add them back because the receiver says, stuff it, I'm not interested. But the temporary differences, we now have to say, okay, what happens here? Now, the easiest way to do that is to say, let's add back what happened with the accounting. So when we're doing assets, for example, whatever you included as depreciation in here, let's add that back because the receiver's going, not interested, okay? We have our own rules. So we say, let's add our depreciation back. And what the receiver says is, we'll give you wear and tear. So in order to calculate our movements in temporary differences, we could say, well, what did the receiver give us this year? And what did we calculate? So if we go to our little calculation, okay, we got 2,500 we calculated as depreciation, and the receiver gave us 5,000. Okay, so we add back the 2,500 depreciation, because remember, that's sitting in there. And I think a lot of students forget that. That's already sitting in the 100,000. You took that off of the 100,000, right, of all your income to get to the 100,000. So you have add 2,500 Rand back so that you kind of eliminate the impact of depreciation. You took it off, now you add it back. And then you say, okay, but the receiver gave me 5,000 wear and tear for the year. And that gives me a movement in temporary difference of 2,500. Okay. Now you'll note, you should be aware of the fact, and this is where it comes from. This is your total movement in temporary difference, this 2,500, and where that comes from is the movement in temporary difference from your balance at the beginning of the year to the balance at the end of the year, which is your 2,500. Okay, so your movement in temporary difference comes from your temporary difference last year versus your temporary difference this year. So a lot of people kind of, in the profit before tax calculation, again, as I said, most students focus on the deferred tax part, deferred tax, deferred tax. So a lot of students put these numbers in the movement for deferred tax in the current income, and that's not correct, okay? Because they're saying, like, talk to me about what happened, the movement in the temporary difference. So you had a balance of a temporary difference last year, and you have a balance of a temporary difference this year. What happened between them? What moved between them? Now, while we're doing this, it's nice and easy because I've just kind of done, okay, you can do, add back accounting and subtract tax, which is nice and easy. Obviously, in exams, it's a little more tricky because you're going, okay, there's, there may be PPE and there's liabilities and there's a whole bunch of other stuff. There could be like 500 different balances and accounts, so it becomes a little bit more difficult. But understand that in terms of the basic, your movement in temporary difference is the difference between the balance last year and the balance this year, okay? And we said that this is taxable, okay? You've created, the movement has created a taxable difference, taxable in the future. In the future, you're going to have 2,500 income and you get no benefit from it. So you're paying tax on that, which means it's taxable, which means it creates a liability. It's not a good thing for you, okay? Not a good thing for you. So this creates taxable in the future. And that means that it is a negative now. And the reason I'm kind of focusing on this, and I want you to look at this in basics, is because students lose a lot of marks because your signs are wrong, because you're adding when you should be subtracting, and you're subtracting when you should be adding, right? So taxable temporary differences are subtracted, okay? Taxable temporary differences are subtracted. Why? Because they are taxable in the future. And if you want to prove that, you can kind of see, add back depreciation, subtract that. Why? Because it's taxable in the future. I got the benefit this year, and it's taxable in the future. If we take a look at the next year, and for heaven's sake, please, 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 can you pay attention and actually do this properly? Oh, I'm so sorry. Why doesn't this work? Oh, idiot. Okay, if you look at 2011, and I'm going to do it under here because I've completely stuffed this up, and I'm so sorry. So if we take a look at what would have happened the next year, okay, we have our carrying amount, our PPE. Now, our carrying amount, we've got like 5,000, and now our accumulated depreciation, we've written off the other 2,500, okay? So we now have 0 carrying amount. And our tax base is the same as it was last year because there's nothing left, is 0, okay? Which means that my temporary difference is 0 and my deferred tax is 0, okay? So we're back to zeros. Why am I doing this? Why is it important? Because I want you to see the movement. I'm focusing on the movement in temporary differences here because it's really important to understand that, okay? It's really important to cover that. So our 2010 balances, I'm just going to write down here because I've stuffed it up at the top there now. I don't want to go back and forth. So our temporary difference was 2000, and there we go. So we had, I'm so sorry. Why is it always the most complicated stuff that I stuff up for you? I'm so sorry. Oh my gosh, okay. All right, so that was our balance last year, right? We had the 2.5, tax base was all written off, so there was no future tax deduction, and there we are. So last year we believed, remember we had raised a taxable temporary difference because the asset, we had an asset that was going to have future economic benefit. There was no future deduction left. Therefore, in the future, we're going to have to pay tax on that income, and therefore that's a liability. And again, can you see why I keep focusing on the future? When you look at that stuff, I want you to keep asking about the future, okay? Assets create income. Income is great, but income creates tax payments. Tax payments are not great. Okay? So I need you to be thinking about, and that's why I say like it's tricky, but I need you to be thinking about that. Okay. Now in this year we're going, there's no future economic benefit left, and there's no future tax deduction left. So there's no temporary difference left. Okay. But now we have to ask ourselves, what's the movement? Okay, because this movement goes to my current tax calculation. So although we're sitting on 0 now we've got to get this to move. So let's go back to my current tax computation and take a look at what happens. So if we say our 2011, let's assume that we're still sitting, we have a profit again of 100,000. Okay, what happened this year? Well, this year we got 2,500 depreciation, great. And we got no wear and tear because remember, we got it all last year. So we don't get to deduct anything. And therefore we have 2,500. And this means that my taxable income that I'm going to have to pay tax on is 102,500. Whereas last year it was 100,000 minus 2.5, which is 97,500. Okay, so what I want you to see from this is that this can you see why this is taxable? And when we talk about, taxable and deductible, it means in the future, right? It's taxable in the future. Can you see that it was taxed in the future? Exactly as we said it was going to be. It's taxed in the future. Okay, so what students kind of look at is go, okay, taxable means like now, and then they kind of go, but Yvonne, why would you be subtracting something? Like, this is a good thing. We're happy about the fact that we're deducting 2.5 because we pay less tax, and that's fantastic. Like, that's a good thing. But taxable is not a good thing. Like, why is it not the same? So a lot of students struggle with the signs because they're focusing on this year only. They're kind of going, okay, what's it? No. This is taxable in the future. And you can see that in the future, the very next year, it was taxable because take a look at what happened to your taxable income. You have to pay tax on more. Okay, and the same would be true the other way around. So just like I put that little example, we can have, we have year 1 and year 2, and we have our accounting and our tax. If you want to simplify it, you could see that although we had, okay, we'll allow you, our accounting allowed depreciation of 2.5 and 2.5, and tax allowed us depreciation of 5 and 0. So that created a difference. But can you see that as a total, it's all the same? It flushes out, it reverses out all the same. It reverses out all the same. Okay, so the total that you got for accounting was 5,000 and the total that you got for tax was 5,000, but the timing was different. So we raised the difference this year because we have to recognize that. And then we raise the difference next year, which flushes that out. And we're now back to 0. Because if you take a look at these two together, you'll find out 5,000. Okay. The stuff is tricky, and it's really tricky to do in half an hour because it's, my goodness, there's so much stuff. And I think the main thing, you're going to be looking at a lot of theory, and I'm going to send you some videos that we've got on our YouTube channel of Richard doing some really basic deferred tax videos. So, and once this is put up, you can kind of go through it a bit slower, and it's fine. You can kind of like stop it and go, what the hell was she going on? That's fine. Very sorry that the stuff didn't work quite well. I want you, when you're doing your next question, when you're doing a question, I want you to take it just a little bit slower and continually ask yourself about the future. What does this mean for the future? And I also want you to spend a little bit more time thinking about what this means, what the temporary difference means, because this is a temporary difference balance. Okay, that's a temporary difference balance. That's a temporary difference balance, but the movement between them, okay, just like any other asset. Like we kind of think, if you took bank, for example, we go, what's your opening balance? What's your closing balance? If your opening balance was 0 and your closing balance was 2,500, then your movement would be 2,500, right? So just like any other balance, just like any other anything, okay? Any other anything, you have a balance, and the difference between them is a movement, okay? And in this, you have a balance, and you need that to raise your deferred tax balance, that's fine. But then you have to put that through your current tax. So balance to balance is movement, balance to balance is movement, balance to balance is movement. So it's when you're doing your, for your current tax purposes, don't only ask yourself what's happening with the deferred tax balance, because what students do is you go, okay, what's happening with the deferred tax balance? And so therefore, I'll raise the balance from there, and then I'll try and reverse engineer and work out, what to do with the current tax. But then I promise you, as you're going through questions and as you do more stuff, your big issue is going to be, okay, do I add or subtract? Do I add or subtract? Do I add or subtract? And you're going to lose marks. It's not your calculations that's going to screw you over. Students are like, okay, I'm going to focus very heavily on the, the wear and tear calculations. And no, be careful. It's your signs that's going to be tricky. So keep asking yourself, what does this mean about the future? What does this mean about the future? And think about what that means. You know, when you have an asset, you've got future economic benefits that you have to pay tax on. So if you've got an asset and you've got no deductions, you're going to be paying tax on that, and that's taxable. That's taxable. Okay, and the liabilities are exactly the opposite. If you have a liability, okay, it's going to be, if you've got a liability that the receiver doesn't recognize yet, it's going to be an asset for you in the future. I'm just going to write that down very quickly. So all of the stuff that I've done, let's take a provision, for example, for accounting purposes and for tax purposes. So you raise a provision for accounting purposes, and you know, that's cool. You can recognize that in your books, right? But the receiver says no. When you raise a provision, the receiver's like, I'm not giving you that. You know, you don't get to take a tax deduction for your leave pay provision. The receiver's like, no. The receiver says, when you pay it, we'll give it to you. Okay, but you're not going to recognize it again when you pay it. So for accounting purposes, you can see again the difference. Yes, it's going to be recognized, but at different times. So for accounting purposes, you'll raise it here. And in year one, you can see you raised it, so your profits are lower. But as far as tax is concerned, they're going, I don't know what you're talking about. I'm not interested. So you'd have to pay tax on that. So it's bad for you now. But then what happens next year? Next year, you don't have an expense. But the tax man says, okay, you paid it. I will give it to you. And therefore, your taxable income will decrease and you're in a better position. And therefore, in this year, in year one, you would have a deductible temporary difference. Why? Because next year, you get to deduct that off your tax. So, you know, if this was 100, for example, and your profit before tax was 1,000 in both years, in year one, you would have to add that back because the receiver's going, stuff you, I'm not interested. So your taxable income that you'd have to pay tax on would be 1,100. You go, oh, okay, that's not so great. So why is it deductible? Well, because next year you don't have anything to add back. You're not recognizing it, but the receiver's going, okay, you paid the money out. Now we'll allow you to recognize it. Now you're able to go, oh, great. My taxable income is only 900, so I have benefited. And why? It's a deduction, deductible. So separating, you know, part of the challenge here is separating the now from the future. But one of the reasons students struggle with it so much is because you're only thinking of the now, you're not thinking of the future, okay? So when you're doing deferred tax, you've got to shift your thinking from, you know, the expense this year and the assets a result of the past, and you've got to go to the future. What is the future? What does an asset mean to you in the future? Future economic benefits. What does that mean to you as far as the tax man is concerned? Okay, I know that it's a lot to take in. I'm very sorry that I messed it up. Very, very, very apologize. Okay, so let me just take a look at some of the little notey dudes on the side there and see what some of your questions have. Okay, if it's deductible in year one, you actually, yes. Right. Okay. So this example, you know, I've kind of simplified this because I want you to see the whole picture. And obviously, you know, this whole flush out system may happen over a period of 2 or 3 years. You know, so it's not always just going to be this year and next year. But yes, that is exactly what it is. If you calculate it and it turns out this way, then yes, it's deductible because it's in the future. You didn't get it now. You're going to get it in the future. Okay, so taxable and deductible means you're going to get it in the future. So for a lot of people, you know, when you're in exams, I want you, and when you're practicing your questions, when you calculate your temporary differences and you calculate your temporary difference, I want you to ask yourself, is this a taxable temporary difference or a deductible? Because a taxable temporary difference, you subtract from your current tax calculation, and a deductible temporary difference, you add to your current tax calculation. And that's completely unintuitive, right? We see it the other way around. You know, if it's deductible, we want to subtract, and if it's taxable, we want to add. So in terms of learning rules, I kind of want you to look a little bit more at your movements in deferred tax and go, has it created a taxable movement or a deductible movement, and you can kind of figure out your movements from there. Do residual values have an effect on the carrying amount? Yes, because and again, this is now you kind of have to calculate what the accounting rules are and what the receiver says. So when you calculate your depreciation, because that's your residual value is going to have an impact on the depreciation, right? So you have to ask yourself, as far as accounting is concerned, I have a cost and I have my accumulated depreciation. And when you calculate your depreciation, what you're doing is saying my cost less my residual value is the depreciable amount, and that my depreciation is like, is 10% per annum kind of thing. Okay, so your depreciable amount, that's where your residual value sits in here, and so that's going to change. That's going to have an impact in your depreciation. So then, when you're doing your tax, you've got to ask, okay, as far as the tax man is concerned, what's his depreciable amount? Does he recognize this value? And he's kind of like, not so much. We'll see when it gets there. But your wear and tear calculation, the rules for wear and tear doesn't say deduct residual value off the wear and tear. The rules say you can, you're allowed to take, your asset. You can take wear and tear of your assets. You can write them off for tax purposes over 3 years. So as far as the receiver is concerned, he's like, what do you mean residual value? Okay. So again, this is the type of thing that flushes out in terms of the differences between your depreciable amount as far as what the receiver is concerned and as far as you're concerned. So the difference that you're kind of going, what does this mean for my deferred tax? The difference you're going to find is in your depreciation. That's where your difference is going. I hope that kind of explains it. It's a little bit of I don't want to overcomplicate stuff because I want you to focus on the basics, but the residual values impact your depreciable amount, and therefore that's going to impact all the changes. Wow, this looks messy. I'm going to have to give you, I will give you the videos and the other examples. But when you're looking at stuff, probably one of the first things and one of the things I want you to keep coming back to and teach yourself to do is future versus now. What does this mean for me now versus like, am I thinking about the future? When you're thinking of assets, do you think about the future economic benefits, or are you thinking about the past? You think about assets and depreciation, which is like about the past. I need you to be thinking about the assets in terms of what the impact is in the future, because that's where your deferred tax lies. What's the future? What's the future? So from here, I want you to take a look at one or two simple kind of, short, simple questions, and I want you to think about it, and I want you to go through this process of focusing on the temporary difference and the movement in temporary difference, and go, balance to balance. What was the balance last year? What's the balance this year? And what does the movement mean to me? The movement goes to current, to my current tax calculation. What does that mean to me? What does that mean to me? The residual, in terms of the residual value, sorry, we just got another question on the residual value. What's going to end up happening with that is that you're going to, for accounting purposes, you're never really going to get to zero. So the nice thing about this particular example is we all got to zero. Your carrying amount was zero and your tax base was zero, and we were all happy. So in terms of your, if you have a residual value, the idea is that you will write that asset down to its residual value, and by that time the tax base would be, would be zero. But the whole point of that as an accountant is that by the time it hits the residual value, you're going to sell it. You're going to get rid of it. You're going to scrap it or sell it, and then you would have to do the calculation as far as what does the receiver think about when you sell the thing. So when you sell it and you sell it for higher or lower than the residual value, or whatever the case is, what happens then? So then it becomes a whole new transaction. It becomes a whole new deferred tax issue, which is what does the receiver think about your disposal on your asset? And I don't want to go into there, but yes, you'll continually have a difference because your carrying amount, if you've got a residual value, your carrying amount is never going to be zero, but your tax base will. So you'll continually have a difference. Then, okay, asset's all done. I've written it down to my residual value of like 100, and now I have to sell the thing, or I've got to scrap it. Now, what does the receiver say about that? Which I don't really want to go in, but yes, that's the basic. Okay. The best thing I can tell you here is I want you to do questions. And when you look at the stuff, and I'm so sorry it's so messy, but when you look at the stuff, it is tricky, and it's so easy to want to go back to the theory and like focus on the words and go, okay, if the deferred tax, if the carrying amount is greater than the tax base of an asset, then it is a deferred tax liability, because it makes us feel like we can remember stuff. But remember that this is how you get your marks, okay? So in the exam, you have to be able to draw this up. They want to see a current tax calculation from you, and they want to see a deferred tax calculation from you. And this is how they want to see it. This is what they want to see. And this is what they want to see, right? So that's where your marks are. So it doesn't make sense for you to be spending your time, focusing on words and, like trying to understand stuff, et cetera, you need to get to, okay, what am I going to have to be able to do with it? This is what you have to be able to do with it. This is what you have to be able to work with. So start off with single item transactions. Go and do the same thing here for a liability, or go and do an asset for yourself. Go and do this for yourself. And I want you to think it through as far as possible. Think it through, and you'll start getting used to how this works. As ugly as it is. Very difficult. And I've taken now just under an hour to do something that basic. So difficult to try and figure out how to do this in such a short space of time. Sorry about that. All right. There's one or two of you have kind of said you need like more detailed help on the stuff. I would suggest that, if you're kind of going, okay, I need more stuff on this, probably the easiest, fastest, quite frankly, and obviously, a big concern for everybody is the cheapest way to actually go through this is to buy the online course, where you then have access to the lecturer, which would be me, and all the videos, which you can then go back through, and continually watch one after the other, like right from the basics to the advanced. My only concern there would be the amount of time that you have. But if you're looking for one-on-one tutor sessions, that's going to be quite expensive for you. That doesn't work out very well because of the expense. So if you're kind of going, I really need the basics and I want to go through it step by step and slowly, I really would suggest you actually enroll, register for the monthly, for the full course. If you're looking and going, okay, that's great, I'm kind of okay with the basics, but I want to see how this works and exam technique, the exam course is really, really good, because that's like, okay, what do you actually do in the exam, and why and how? Like, how do you do this in the exam, and why do you do it in the exam, and why do you do this, and how does it work? As opposed to just going, here's the flat solution. You actually have someone working through it and going, you would do this first, and then you do this because of this, and then. So, what you do with this from here, obviously totally up to you, but I do really ask that you think about it, and your main thing is think about the future, think about the future, think about the future, think about the future. Otherwise, you're going to be in trouble. Okay, I wish I could leave you with a sense of like, this is all awesome and deferred tax is going to be fantastic, I'm going to nail the thing. The reality is you're only going to nail deferred tax if you practice the stuff. And you're going to have to practice it, and it's going to suck, and it's going to continue to suck, but the more you practice, the more marks you get. You're going to get those weird transactions in exams, okay? Like they may say to you, oh, you bought like an intangible asset. I don't want you spending 100 years on like what to do with an intangible asset in your, in your deferred tax if you don't know and you've never touched it before. I want you focusing on what you do know. So they're always going to throw. There might be 3 things that impact deferred tax in your case study. If one of them is bizarre and weird, that doesn't mean that you're going to fail. leave the one and do the two that you can do. Students are like, okay, if there's 3 transactions, I've got to do all 3 of them. And if I don't do all 3 of them, I'm going to fail. And therefore I sit on the 3rd one, and I sit and I sit and I sit and I sit and I struggle and I struggle and I struggle. And then time's up, go home, and we fail. No, if you look at the 3rd one and you go, I don't know what the hell this is, I don't know what to do with it, I don't know where I'm going with it, then leave it out and do the 2 that you can do. Do the whole thing for the 2 that you can do so that you can get marks for those. They will always throw a transaction in there that's weird. They will always throw something in there that's iffy. If you don't know what to do with it, leave it out. Get marks for what you can. Deferred tax is not one whole thing. It's made up of a whole bunch of different balances. Get the marks for the balances that you can, please. Your biggest issue here is time and what you do with time. And I want you to spend some time thinking about this now so that in an exam it becomes a bit more of a rhythm. You cannot do a deferred tax question twice before the exam and think that you're going to pass. Deferred tax is something that you have to get muscle memory on. You're going to have to do this. I want you doing at least 10 questions on your own, not looking at the answer and like, oh, okay, that's what the answer should look like. I need you struggling through at least 10 deferred tax questions on your own, because that's what creates the muscle memory. You're going to suck at them. And that is okay. If you suck at 10 of them, that is fine. You will just start finding that you suck a little bit less. Alrighty. Are there any other questions before I close? I think one of the things we're getting a lot of questions about is the exam process. Are you guys all happy with thus far what UNISA said about the exam process? They haven't given specific details of exactly how they're going to do them, but you guys are all comfortable that the exam is happening. Are you all comfortable that you are continuing to study the same way? Your exam is going to be the same. You're going to write it at home, but the whole thing looks exactly the same as it would have been if they put it on your desk in the exam center. So, I've got a couple of students going like, should I be studying differently? Should I be doing anything different? The answer is no. The exam is going to look the same as it would have. If you were sitting in an exam center, the only difference is that you have to download it yourself and you have to do it at home. The fact that you're at home does not make it an open book exam. Students are like, oh yeah, but okay, so it's going to be the same as CTA exams and therefore it's an open book exam. No, CTA is an open book exam, so therefore at home it's an open book exam. Your exam is not an open book exam. It must be done on your own, all by your little lonesome, exactly the same way you would have done it in a venue. You just have to focus and work and understand, make sure you're comfortable with the upload and download process. So I've got a couple of students who are going, I haven't already started studying because I'm not sure what the exam's going to look like. The assumption you work with and you study, the exam is going to look the same that it always was. Same amount of time, same process, same exam, same questions, same thing they want from you, but you don't have to sit in traffic to get there, and you don't have to listen to some idiot in the table next to you coughing. It's you. You can do it in the peace of your own home. Are there any other questions before I log off? I think everybody kind of hangs around. I don't know if you have your own questions or if it's because you're waiting to see if other people have questions. Do you have to use the prescribed book for the exam? That depends on who you're studying through. If you're using our courses, then no, because the stuff that we have is in there, so you don't need the prescribed book. But if you're studying on your own, then yes, you do, because otherwise, like, you're struggling to get content. You don't actually have the explanations, and the TUT letter says, okay, go to the textbook. But to study for that, yes, the exam itself, obviously there's no open book. In the exam itself, you get nothing. It's you and your pen and your paper. So I'm not quite sure what you're asking. Do we have to use the prescribed book for the exam? Writing the exam, no. Studying for the exam, yes. If you're studying through to Boldy, no, because we give you all the information that you need. If there's no other questions, I'm going to log off in 2 minutes if you don't have any other questions. Otherwise, everybody sort of waits for everybody else. We're all good? You're all good? I hope this has helped even a little bit. And I know that it probably hasn't solved all your problems, all your deferred tax problems. It was never going to, but at least I think it gives you an indication of where to start and where to start thinking about the stuff. and how to think about the stuff as opposed to just like trying to, you know, figure it out all by your little lonesome. Thank you for your time. I will be contacting the winner. You will get an email. Can I quickly explain the disclosure of deferred tax assets and liabilities? Kind of not so much. The disclosure, I'm going to see if I have a video that we can put on YouTube to go through that, but I'm not going to cover that here. So I'm going to see if I have a video that we can put up, or we can find something else, or you know, give a format or something. The importance of disclosure with regards to marks, it is important. You do need to be able to disclose it more and more. They're kind of saying to you, here's the case study. I want you to do the deferred tax calculation. I want you to do the current tax calculation, and I want you to do the disclosure. And what they're basically saying is, do you know what the hell happens with the stuff? You know, it's not good enough that you know the numbers. Do you know where they go? You know, the whole purpose of what you're studying is the financial statements. So it's basically like, do you know what to do with the stuff? You know, like, do you know what it actually looks like? It's all well and good that you can calculate the number, but you know where it goes. So yes, the disclosure is very important. You do have to know how to do that. And for exams, you do need to work quickly on them so that you're able to say, you know, in an exam, if they ask you that, you're able to balance your time out and go, okay, I've got X amount of time to do the deferred tax calc, to do the current tax calc, and to do my disclosures. And, you know, how am I going to balance that time out? Because each of those are worth marks. So yeah, you are going to have to get comfortable with that. Thankfully, there's not like a crap ton of writing. You know, it's not like sentence after sentence after sentence after sentence. You know, but the challenge is separating. Most of the challenge that students struggle with deferred tax disclosure and tax disclosure is separating current tax from deferred tax and separating balances from movements. And I think this will be helpful because you know, you're kind of aware of the fact that you've got to go, okay, what's deferred tax balance? What's deferred tax movement? What's current tax balance? And what's the current tax expense? You know, so that, you know, that should help. We've got one question from someone. Do we offer notes that we can put? We don't, like, yeah, we don't do notes. All of the stuff that we do is on video. I suggest that you send an email and see what we can help you with, but we don't do notes, because basically, you know, if we did notes, you know, we'd basically just be doing the same thing as the textbook, you know, which is to try and explain everything word by word, and that just takes like a million years. So no, we don't give you notes, because, you know, then we'd be rewriting the textbook, which we don't want to do. So unfortunately not. But send an email and see, like, let's talk about how we can help you with that. Okay, and then I think we are done. I semi-apologize for the fact that we went over time. I hope that it has helped you a little bit, and I hope that you enjoy the day further. Have an awesome one. Cheers, people.